Good afternoon and welcome to this webinar on recent banking turmoil. I'm Thorsten Beck. I'm the director of the Florence School of Banking and Finance, and I will moderate this webinar. And I'd like to mention this right away. This is joined with the program on international financial systems. Now, if you tuned into the seminar, I probably don't have to motivate the topic of our discussion very much today, but just to remind ourselves, so we had the failure of Silicon Valley Bank a couple of weeks ago in the US, followed by some other banks and some significant pressure, one could argue, on a specific type of banks. Then we had almost 2 weeks ago now, the failure, well, maybe not failure, well, some kind of managed failure, I would say, of Credit Suisse in Switzerland. And some would argue an unconventional management of this failure, and more concerns that have then also prompted supervisory reactions. Now, to discuss these issues during the next hour or so, I have 3 excellent panelists who can give us very different, very complementary perspectives from both sides of the Atlantic. Let me start with Elena Carletti, who is professor of finance at Bocconi University, a past president of the European Finance Association, and she's also a non-executive director at UniCredit and the chair of the risk committee. I would like to stress here right away, and she would do this herself probably too, that she will speak only in her personal capacity, not linked to UniCredit at all. Second, we have from the other side of the Atlantic, Stefan Galwel, who is the vice president of, or the vice chair, excuse me, at the Program of International Financial Systems, so our co-sponsor today. And in this capacity, he leads the Executive Education Initiative, developing programs for policymakers at government and regulatory bodies globally. He also has a long history, a long career in banking, or more generally in finance. And then last but certainly not least, Corso Pavagnoli has been a managing director and Lazard since 2008. Before that, he actually chaired a working group on NPL mandated by the ECOFIN. And he has also, again, a long history, a long career in banking on both sides, on the regulatory side and on the private sector side. So welcome, everybody. Now, just before we go into the discussion, let me also mention, just for the logistics, we want to make this as interactive as possible. And I would very much welcome any questions that you have, the audience, from through the Q&A box, and then I will choose which questions to pick. So let's get started. And maybe in the first block, let's talk about what did go wrong. And we have two sides and 2 very different types of failures, one could argue. One is Silicon Valley Bank. And let me maybe start with you, Stefan, please. In a few words, what went wrong?
Great. Good afternoon, everybody. By the way, my comments will also be on my own and not necessarily the views of the Program on International Financial Systems. So in short, what went wrong at SVB? Well, in short, interest rate risk. SVB, as you probably know, was a highly specialized bank in California, serving kind of the Silicon Valley community. They had a huge upsurge in uninsured deposits during the pandemic, which they matched off with investments in long-dated U.S. Treasuries. They had 190 billion of deposits, 93% of which were uninsured, supporting 120 billion of treasuries and agencies. As funding dried up in the tech world, post-pandemic, clients started to withdraw deposits at an unprecedented rate, which then forced them to sell some of these securities at a loss. That led to additional deposit withdrawals on, they attempted to raise equity on March 9th. They failed. That led to additional deposit withdrawals, and then this contagion spread to other similar regional banks, not narrowly focused regional banks, including Signature Bank, which failed, and First Republic, which did not. So aside from interest rate risk, the other kind of core issue was the fact that many of these securities were held in the held to maturity book, and raises questions both about how securities get placed in that book and also about deposit modeling more generally. So I'll stop there.
Thanks. Very quick follow-up question. So is this different from 2008? I mean, you mentioned there's a specific type of banks being affected by that.
Well, absolutely. First of all, we're talking about what I would call money good assets here. These are not subprime mortgages. These are not toxic assets. These are government securities mostly, which eventually will come good over time. So that's one fundamental difference. I think the other difference is, and we can get into this in more detail, is kind of the lack of contagion in the classic sense. This was not a bank that was interconnected globally with other banks. It's in a sense, I would say, in fact, this resembles not so much 2008, but the savings and loan crisis that we had in America in the early 1980s, when we had small banks which were overextended in real estate, and when interest rates went up, were forced into insolvency.
Okay, well, thanks, Stefan. Let us turn maybe then quickly to the other side of the Atlantic, Credit Suisse. Elena, what went wrong in Credit Suisse? And are you surprised?
Well, first of all, good afternoon to everyone. I think I realize it's the first time that I speak as a seminar participant in an FBF event rather than as an organizer or a chair. Having said that, as Thorsten said, I speak entirely on my personal capacity as professor, not at all as UniCredit. So what went wrong was something completely different from what went wrong in the Silicon Valley. So we have to go back a little bit, a few years back, when Credit Suisse started having the large exposures into troublesome institutions and then eventually failed, the Green Seal on the one hand and Archegos on the other. And on both cases, Credit Suisse made actually ingent losses. So only to Green Seal, it had an exposure of about 10 billion, and then it recovered about 7.5, 7.6 billion, but it lost quite a lot of money. And from there, this was together also with scandals in governance, changes of CEOs, changes of chairmen, lack of proper risk management and risk culture, up to a point that in the last accounting of 2022, the disclosure was delayed, there was again a loss. So Credit Suisse was a bank that had been in trouble for some time, and maybe differently from Silicon Valley Bank, the problems were more on the investment type, or anyway on not certainly on concentration deposit and investment in government securities. So very different. Shouldn't have gone this way, and was I surprised? Well, I think in normal times we would agree that Credit Suisse would have not ended up where it ended up. So what happened at some point was that the markets were very nervous, very emotional. Maybe the credibility of the plan that the management had to put forth was still not so strong, let me say. But then it was enough, in a world of media, Twitter and so on, it was enough that the chairman of the Saudi Arabian bank said that sentence that maybe was not really meant as it was interpreted, but it was a non very cautious sentence at least, or open to interpretation. And that led to maybe a manipulation on the market of CDS, short selling, and a very rapid drop in the share price of Credit Suisse, linked with, and that is the only similarities maybe with Silicon Valley Bank, a quite a big outflows of deposits rapidly, and also of money for the wealth management. But that had already started some time before. So altogether, we end up in a situation where the bank became sort of, the situation became unsustainable, although the bank was, by all parameters, solvent, liquid enough, had enough capital, and so on and so forth. Let me stop it maybe.
Yes, and maybe just to get this out of the way, just for the moment, to which extent are the failure of Credit Suisse and the failure of SVB and the more broader problem in the regional banks are linked? Was there spillover of, I'm not sure, emotions, as you said, Elena? What, and also maybe Corso, if you want to mind coming at this point.
Yeah, sure. Thank you. Thank you very much for inviting me. And here again, I have to say that I speak on my pure personal capacity and not as Lazar, based solely on public information, obviously. Yes, to your point, so the two events are pretty different in their nature. The kind of credit institution we're talking about on the one side and on the other side, the kind of problems that are accumulated on each side. All those, are very different. However, there's a similarity in the two crises, which is, in the end, as I would say always, as very often in banking crisis, it's a liquidity crisis. You had deposit withdrawals at SVB at a rapid pace and a run on deposits. And on the Credit Suisse side, you had actually large outflows. You had an episode of outflows, you remember, back in the autumn, which was more or less done by the bank itself. And you had a large new episode of outflows following the panic and the comments of the chair of the Saudi institution. And as a matter of fact, during the very crucial week just before the failure of Credit Suisse, the bank was under emergency support from the central bank, under ELA. So in both cases, it's in the end it's liquidity, and that's and in liquidity boils down to breach of confidence. But I think it's a comment that may connect to other things we may say later on, because when you look at solvency ratios, both banks were actually pretty comfortable when they failed, and that's but that's not again not something unusual. Banks can have good solvency ratios and fail on liquidity issues. We've seen that in the past several times, but that connects to the debate on bail-in and 81, as we may discuss further down the road.
Thank you. So just to put it even more bluntly now, would Credit Suisse also have failed at this point 2 weeks ago if it not had been for SVB? Elena or Stefan?
Well, maybe I give first and then I leave it to Stefan. I think under normal situations, it wouldn't have. I think this trigger of this famous sentence, plus, as I think, and we may want to touch it later, the role of the CDS and the markets in a moment of highly liquidity and highly emotionality played a big role, at least on the speed of the failure.
Okay.
I think that's a good point. I mean, I think Credit Suisse was ready to topple, if you will. It was a question of what event was going to be the triggering event. I'm not sure if it hadn't been SVB, it might have been something else. But I think Credit Suisse was a long-standing, as everybody knows, has been fragile for quite a long time.
Okay, good. So we're not going to talk about the econometrics of establishing causality, obviously, here, but okay, thank you. Maybe Stefan, if I may stay with you for just a moment. So we got a first question here. We learned that 60% of US banks don't hedge interest rate risk. I'm not sure whether it's true or not. You can tell me. If you expect no contagion from SVB, the same consequences from the same causes are to be expected in many other regional banks. I mean, you alluded to this already a little bit. Risk is linked with the number of small, mid-sized failing banks. What do you think? Could this be even broader than the group of regional banks?
Well, obviously, I don't know all the details of all the bank balance sheets. Certainly, interest rate risk in general is going to be a challenge, and I think even if a bank doesn't hold vast quantities of U.S. government securities, they may hold mortgages or other long-term assets. So I think there's no question that interest rate risk is going to is going to create some stress. That being said, I cannot think of a better telegraphed event of any kind. This is not a hurricane. This is not some kind of IT issue or attack or something. This is something that's been widely telegraphed. And I would argue that most banks should have prepared themselves to some degree. Maybe in fact, as a general rule, banks generally do well in rising interest rate environments. The challenge is, of course, if they rise faster or more quickly than expected. So I think I'm going to take the view that this is relatively contained.
Okay, so that's a bit reassuring. But now, is that actually, I mean, as you said, we had a similar situation in the 80s. Well, but is that then basically supervisory failure? Could they have foreseen this? Could they have intervened earlier?
Well, I think obviously it's primarily a management failure, but I think there is a supervisory
yes,
issue.
Of course,
yeah, but there is a supervisory issue. If you look at SVB, and again, watching the Senate hearings last week, it does appear that the Fed, in fact, did issue a substantial number of warnings to management about this issue in the past. The question really becomes one of escalation. Did they why was the board not involved more earlier in the issue? It does appear that maybe these warnings were not made sufficiently, didn't go high enough up the chain. So yes, there's going to be questions about supervision. The Fed's conducting a review of what happened. As I've mentioned before, this is a highly telegraphed event. One does have to ask the question about supervision.
Yeah, or is it also has to do with the fact that SVB was not under Basel III, which of course I think was a change undertaken a couple of years ago under the previous administration. Does it have anything to do with this, Corso?
Well, let's separate out.
Okay, Stefan.
Sorry, please.
Stefan, if you want to.
You want me to go first and then turn
yeah,
it over?
Please, Stefan, go ahead.
Okay, well, let me just, I know the Europeans have always been a little frustrated with the Americans that we have not applied Basel III throughout our banking system. And I will come back to this point later, that the political support of small and medium-sized banks is very, very strong in America. And there's a lot of tension about this right now. I guess, as was earlier said, I don't think the capital was the issue here. Except perhaps this issue that we can delve into deeper about how do you handle unrealized mark-to-market positions in held-to-maturity portfolios. I think that is the one perhaps area of capital that's worth discussing. But what I think in terms of the 2018 changes to regulation, once again, I don't think those were the primary cause. The stress tests that were imposed on the largest banks in the US actually were stress tests for lower interest rates, not higher interest rates more recently. So it's not clear to me that if you would impose those standards for big banks that it would have made any difference. That being said, and we can get into this a little bit later, there's going to be a call for additional levels of regulation for these kind of larger regional banks.
Yes, well, that wouldn't be surprising, of course. Yes, Corso.
Yeah, no. I mean, a lot was said already. I think, as always in this kind of, big failures, it's an addition of mistakes. It's never, and those mistakes come together and they provoke this event, by the way, which cost a lot, $20 billion US for the FDIC as a gap. So it's a very costly bank failure. No, I think, just to complement, I think another element is accounting. When you report under IFRS, as opposed to other different standards, you don't have the same flexibility to what you're going to be able to put in the AFS or the banking book. And to the point on the regulation credential, to be fair, I agree. It's not fully, if ever the American banks had applied full Basel III, I don't think that issue would have been totally solved, because interest rates risk in the banking book is a Basel III feature, but it's a Pillar 2 feature, and it's been a heated debate for years between bank and regulators how you should apply that. So in fact, the way we are assessing, measuring, and implementing, I would say, capital safeguards for interest rate, especially in the banking book, interest rate risk is, I think, a topic for debate, which will certainly come back after this. That being said, let me just make a last comment. Maturity transformation and interest rate risk is the job of banks. So, I've seen a lot of articles saying, that should not happen anymore. I think, that means we don't have banks anymore. So we have to find here a reasonable middle ground between obvious improvements and the fact that, again, maturity transformation and interest rate risk is what banks are supposed to be doing.
Yes. No, I mean, I did not imply at all that it's not primarily a fault of bank management, obviously. And I mean, a lot has been written about that, of course, including the fact that none of them are working actually in California. They were all working remote. And I mean, it has also entered, of course, a political debate with accusation of woke banking. But maybe let's not go down this road, at least not for the moment. But in the Q&A box, we found yet another culprit, possible culprit, the role of the rating agencies. Ratings of outstanding senior debt SBB were confirmed by major rating agencies at the beginning of 2023. Is that, not sure, Corso, Elena, Stefan, what is that? Can we blame the rating agency, or did things just go too quickly?
I think they went too quickly. I mean, they went too quickly, and also, I mean, in a way, rating agencies are more concerned with credit risk, and
yeah,
I mean, there was no credit risk, as Stefan said before. These are government-backed securities, so it's really a matter more of interest rate risk and very long duration. That
no,
is
we're talking about the debt of SVB, right? So
yeah,
these the ones that SVB issues, and that's, I mean, again, if
no,
the interest
again,
rate
but
maturity
SVB
mismatch
did
comes
not.
in, yeah.
What I'm saying is that SVB did not really have an issue of credit risk in its balance sheet.
That's
So
true.
the fact that
Yeah.
you know, debt issued by SVB, what should have, what should incorporate? I mean, that is the extent to which extent interest rate risk should be reflected in ratings.
Yep. Okay. Let's maybe move for just a moment to the markets and to the speed with which all of these things happen. And some of you have already alluded to it. Let's maybe start with social media. Because I think, and now I have to admit, I don't remember the name anymore. This the SVB kind of was kicked off with a tweet by somebody pointing to this interest rate mismatch, and then things went very quickly. So kind of information contagion, if you want to. But then, of course, also we're not in it in the age of our grandparents' bank run anymore. We don't have to line up anymore. We can just go to the internet. Not even that. You can go to your mobile phone and withdraw money, right? So to which extent has that played a role? The social media, internet, the connectedness of the world in this, in what effectively in both cases was a bank run.
Well,
let me open. Well, wants to come in first.
Stefan, yes. At least let me take a crack at it. First of all, just the facts. I mean, certainly the speed of withdrawal at SVB is absolutely stunning. I mean, on March 9th, 42 billion of deposits were withdrawn from SVB out of that total of 190, and another 100 were already queued up to be. They could see in the queues were scheduled to be withdrawn when the Fed intervened. So when you think about it, in 2 days, 142 out of 190 billion of deposits were going to leave this bank. I mean, that's just a speed that, and actually what stopped it from happening even faster was not the communication of the withdrawals, but the payment system, you know, the working through, you know, how do you transmit instructions? What are the closing times of payment systems? Those were the only real breaks on what happened, actually. So this was unprecedented. And so it's undoubtedly social media had something to do with it, though we can debate whether one particular tweet or another impacted it. Actually, in 2008, when during the Northern Rock crisis, they tried to do the same thing, but the website crashed. And
well, yes, that was 15 years ago. I guess websites were not as robust back then. Yes.
so you can see the so-called progress, if you will. But I think this is a real challenge. I mean, it upends a little bit the traditional way that we deal with crises, which was kind of to wait till the weekend, limp through the weekend, and then try to come up with a solution. I think policymakers are going to have to be working 24/7 now, and I think it creates quite a lot of pressure to come up with solutions more quickly, and probably have solutions ready on the shelf, perhaps more quickly than we have in the past.
But if I may interject, I mean, I subscribe to everything Stefan said. On the other hand, I guess the question for me is to which extent that is replicable, because Silicon Valley Bank had such a peculiar liability structure. Right? I mean, the concentration of deposits and the sophistication of the depositors in Silicon Valley Bank is not typical of a bank. So, and then brings back to the question of a regulation. Was there really a regulatory failure? I mean, not to point to anything on anybody, but the fact that they didn't have liquidity regulation, maybe that contributed to this very peculiar liability structure. I mean, I think it's very difficult to find a bank that would have such a liability structure simply because you're not allowed to have it. So that should slow down the speed with which this event may happen, but much faster than in the past, for given a liability structure, that's for sure.
Okay. What do you think more generally about the reactions in the market? We're not coming to AT1 yet. We're going to do this later. But the reactions in bond markets or in other markets.
Also. Yeah, no, a very good question. I think, well, the reaction has been one of high anxiety and volatility in, I would say, both in equity markets and in credit markets, as far as banks are concerned. By the way, we have not seen a lot of credit rating actions yet on banks, which is to be noted, given the procyclicality of rating adjustments in those kind of crises. So we are in a very, very volatile environment, and we've seen that. I mean, as you very rightly said, Thorsten, I mean, the Credit Suisse crisis is somehow, an echo of the SVB crisis, and it was the match, which created the problem, which was unresolved, and one of the reasons why it exploded was because SVB had problems a few days ago, and we've seen the episode just a week ago on the European banking stocks after what happened on the Deutsche Bank CDS. So this is there are a lot of elements here: global anxiety, I would say, macro anxiety, anxiety on the financial sector, poor liquidity in some markets, especially in the CDS markets, and so all this is creating, of course, a lot of volatility.
Yeah.
If I can join here.
Stefan? Elena? Yes.
No, I just want to say, I mean, I think the most extreme movement in CDS market that has caused a problem, and hopefully temporary, is the case of Deutsche Bank, where we had with 20 million, the increase in CDS was so significant that led to a 15% drop in share price the day after. Then luckily, short seller closed their position, and the stock price went up again. But the violence with which that happened is also something that we haven't seen very often. And this is, of course, due to the liquidity of market, of the CDS market.
No, exactly. I mean, this is also something that Andrea and Ria actually picked up a couple of days ago in one of his, I think it was an interview. I mean, what can you do about it? I mean, do we need less? I mean, if you have illiquid markets, shallow markets, I mean, is there any way to kind of prevent things from that happening, or should there be then a supervisory reaction if something like this happens?
I think you can do different things. I mean, the most extreme is something that is possible in Europe, though, in continental Europe, which is to prohibit naked CDS for a while. And this is a tool that ESMA would have available. It was introduced after the euro crisis in 2012. And of course, you would allow only CDS as a hedging instrument. So you have to have the underlying asset in order to be able to buy the CDS. Of course, there was a lot of debate already at the time around that measure, because of what Corso said, the CDS market is already a market which is not highly liquid, maybe more the sovereign, but not certainly the corporate. If we then prohibit naked CDS, this would further reduce the liquidity of the market. But I am of the opinion that when markets are highly liquid, and therefore this is no longer a market signal, then is a manipulation. So ultimately, it's a wrong market signal. And that can trigger events that are completely then out of fundamentals in a way.
I think the CDS discussion is a little bit like the short selling discussion that we had in 2008. And I must admit, I'm going to be probably a little cautious here in the sense that I'm reluctant to, we could, at the time we talked about banning short sales for banking stocks, right? In fact, there were measures that were put into place. I was always against that idea. I do think that if you dampen down market signals too much, all you're doing is delaying the pain that's going to happen anyway. That being said, the idea that just as we have circuit breakers and stock exchanges and other mechanisms to kind of, I don't know about the covered, it's an interesting issue, this covered CDS issue. We should take a look at this, but we should also be careful not to dampen all market signals, because often short sellers, other people are providing information that are telling hard truths that regulators and investors may not want to hear.
No, that's not the case. Actually, that gets me to a question in the Q&A box. So we have seen it when markets become irrational, there's hardly anything you can say to reassure them. Once trust has evaporated, issues related to information asymmetry are amplified. From a communication standpoint, what would be a good strategy? Now, I'm not sure what what Chris Christophe refers to, whether it's more on the bank side or the supervisory side, but let's just address both. What is a good communication strategy in this kind of situation?
Be silent.
Of course, so maybe you.
No, that's a tough one.
Yes, I know.
Look, I mean, I can speak maybe based on my own experience, having dealt in my previous life with a couple of banking crises during the 2008, 2011, so global financial and euro crisis. There's no easy communication line and no pre-established communication line. By the way, going out, as happened last Friday, we had the leaders, European leaders, head of government, head of state, saying the banking sector was fine, no worries, and so on. That's good up to a certain point, because it can also backfire, because when you have the highest level of the state saying everything's okay, so it's really a matter of being very targeted and measured, proportionate in your communication. I think the best answer is really with transparency. And you remember the discussion we had in the Eurozone crisis, 2011, with all around the EBA stress test. You remember the discussion how you should stress test the sovereigns in the book in the banks. And how did we come out of that? With transparency. It was painful, by the way. A lot of debates, a lot of discussions, a lot of volatility. But in the end, that's what did, in my view, the job.
I think going back to the Euro crisis, yes, indeed. I mean, Mario Draghi was probably the epitome of a good communication strategy, which was very simple and very clear and not too much detail, which I think there is some merit to that. The US did something similar in the 1980s when when we had a dollar crisis, and every US Treasury official since that time has reiterated that strong dollar policy, no matter what the dollar is doing. But I think it's very hard in real time, as we saw in the US, this question we're having about deposit insurance. We had different parts of the government saying slightly different things about that. And I would say, simple is best, and then be honest about the details at the right time.
Elena, anything?
No, I think I very much like what Corso said about transparency, which brings back a little bit the discussion to the Held to Maturity book, if I may jump.
Yep.
Because in newspapers we hear all the time, and I think the press has a big role in spreading panic that is not very well grounded sometimes. So the word hidden losses is already a word that should be banned from communication, because there is nothing hidden. So in particular in Europe, it is true that the bonds that are held in the Held to Maturity book, for example, are accounted for at the historical value. It is true that they don't enter into regulatory capital. But having said that, the market value of those bonds is fully disclosed. So investors can very well look at the disclosure statements of banks and figure out what potentially the realization of the loss would be if these securities would ever be sold, or used for repo, how much liquidity banks would be able to get. So in a way, so that is the transparency that I think we need, and that hopefully will calm down the investors.
Okay, so it's as I cannot summarize this, it's more transparency, but also not, but also clear. Not. Let's move on to the kind of another block. The reaction, the regulatory reaction, and maybe let's talk first about SVB. So there was first, of course, basically the bank being closed, and insured depositors would get their money back through a kind of it's not really a bridge bank. It was more like a bank where depositors would have access to the insured deposit, would have access to their funding, to their deposits. But then there was a quick turnaround, also from the FDIC, basically ensuring everybody. But actually, no, it wasn't just the FDIC, it was a higher level, I think. Stefan, maybe you can provide us a little bit more details on also what you think of this kind of reaction. I mean, the most important thing, of course, I mean, we economists, we love to talk about moral hazard. And that seems really a big thing, negative item here, to make all, including uninsured depositors whole, which of course, then first they said it for ECB, then they said it for all the mid-sized banks, and ultimately, due to political pressure, they had to go to basically all the banks.
Yep. No, thank you, Thorsten. I think this is the key issue, actually, and where there is the most contention. I think if we look at how people react, what the reaction was of the regulatory community during the crisis, there were certainly the fact that the Fed said that this was systemic was kind of a shock in a sense, because we think of systemic in terms of the global financial crisis. But they had to do that. It was very highly technical in order to have this guarantee of deposits for those two banks. So it was a technical reason why they had to use those words, but it was nonetheless kind of a shocking word. The next big surprise was the Fed coming out with this program to swap assets, which actually was a great program because, as Elena just pointed out, I mean, I think having the central bank stand ready to buy government assets at par value, I think is a very good program and makes perfect sense. That was great. The one agency that acted kind of in the completely normal way was the FDIC, which did their usual thing. They closed the bank down and tried to find a buyer, and they acted exactly by the playbook. But this question about uninsured deposits is really the kind of the key issue, and we're seeing calls to extend deposit insurance more widely. I think that does have tremendous moral hazard to it. But I do think one very interesting idea is something the FDIC did a number of years ago, actually, which was they paid out uninsured depositors at 80%, with kind of a promise to make up the balance over time. And this was done as kind of a one-time thing, but I think it's worth looking at. If you can give, in fact, if you look at during the middle of the SVB crisis, there was a secondary market in uninsured deposits trading. And it was trading 50 to 80% of value. So I think if you can provide some kind of mechanism or some kind of expectation of how uninsured depositors will be treated, I think that would go a long ways towards repeating the same kind of situation. Because these are sophisticated, big uninsured deposits. They're not. This is not mom and pop.
No, exactly. These are large tech companies, supposedly, right? Well, not large ones, but they were tech companies and corporate deposits. So, but isn't that also a little bit of a contradiction? I mean, at the beginning, we said that this is not really a systemic banking crisis. This is concentrated in certain banks. And then the government, the Federal Reserve says, oh, well, there's a systemic exemption here. I mean, that's...
Exactly. So I think...
doesn't that raise the risk of even more panic?
Absolutely. And so I think where we may be heading, and certainly the Biden administration made a very broad statement overnight, which I haven't fully digested, but it seems to me we need to create kind of a class of domestically systemically important banks. And I think the same thing applies to Europe, by the way, where we had, I don't know how you treat Sao Paulo or other banks in Europe, but I think you do have a class of banks that don't reach the level of global systemic risk, but nonetheless can have important impacts on domestic markets. And we probably need to think of some way to separate those banks out and provide some higher level of oversight for them.
I mean, actually, we do have this discussion here in Europe because a set of banks which are considered significant institutions, but they're not being considered, their resolutions are considered in a public interest, so they would actually go to liquidation, which ultimately means they're not being liquidated at all, they're not being resolved, but they're being sent into public recapitalization. So, but that's maybe a different discussion we can have at another point. Elena, Credit Suisse, how do you see and I think if I remember correctly, you kind of see the reaction as a positive one, the way it was resolved over a weekend, which was certainly impressive, the way of amount of both legal work, but also of economic work going into it. But it's not kind of what we would have expected, right?
Well, it was funny because I was just giving an extra class doing the master just before joining this seminar. And one of the students said that the authorities had a lot of time to deal with it, a lot of time. They had 2 days, they had 1.5 days probably to deal with this and to understand. I think, I mean, at that point, the authorities had to do something. And I think they would, let me say, it was not the only solution. So let me maybe list what the solution could have been, and then maybe we can say whether this was the best one. So that was one solution, was what happened. Another solution would have been to sell Credit Suisse in pieces, But of course, the speed at which this should have occurred, and given that it's a cross-border bank, this may have been difficult. And there were, of course, a huge national interest in keeping Credit Suisse Swiss rather than selling it to BlackRock, assuming that the rumors of the newspapers were correct. Another option would have been that the state would have taken some stake, and that would have calmed down the markets. So maybe the most interesting question, rather than saying why didn't they sell it in pieces, given the complication and the short time available, is why the state decided not to enter and rather find a private solution. Now, there are many things that we may discuss. One possibility is clearly the discussion of taxpayer money and the credibility somehow, right, that we have tried to build up after the crisis with the fact that the government should intervene as little as possible. And what the entry of the government into this as a shareholder would have implied for the bail-in of the creditors. Now, of course, we'll talk more about the 81, but clearly, if the state would have entered, probably we would have seen even a broader bail-in application of the bail-in, and what would have been then the consequences then? I think Torsten froze.
So basically also bailing the equity holders. That's what you're saying.
Well, you would have frozen the equity holder, but maybe you would also have bailed in. Maybe you would have gone even above the 81. I don't know, depending on the size. But certainly the government putting more money would have been more delicate for how many losses the creditors would have borne. But maybe Corso can say even more.
Yes. Indeed, Corso, let's talk about 81. Let's talk about well, it wasn't a resolution of Credit Suisse, right? It was, as Elena just said, it was a private solution. I mean, private in very thick, bold and italics underlined quotation marks, I would argue, because there was a heavy hand of the government, of course, in there.
Yes, look, I mean, I 99% agree with what Elena said, except for maybe for that, I think, both in the case of SVB and Credit Suisse, let's call it what it is. It's a bailout. I mean, it's in Credit Suisse, you don't have actual cash, government cash put into the bank, but you have huge guarantees, very broad in scope. I'm sure you all looked at the details. And second, the central bank financing was done, as you understand from press release. So I'm talking about based on public information, was based on unsecured exposures. So in the new facilities that are going to be put in place to support the new bank, that's going to be partially guaranteed by the state. So the central bank will get a state guarantee. So I would say the state hand is everywhere in that rescue. But to be frank and to go into Elena's direction, it's a kind of hybrid model because you cannot say that the resolution rules were simply thrown into the dustbin, because some part of what the Swiss authority did is actually the resolution textbook, and clearly, they cancelled 16 billion euros of 81, and that's totally unheard of. I mean, in the popular case a few years ago in Spain, 3 billion of 81s were cancelled. That's the only other case, to my knowledge, in Europe where this has occurred. And here, the authorities have taken this massive decision to cancel 16 billion euros of 81, and that's part of the resolution textbook. So they did a bailout, but they did apply some of the bail-in textbook with the new instruments that were designed to help resolution. So we are clearly in a kind of hybrid situation. I think where it's pretty challenging, and I think we could have a whole session on that. It's a fascinating debate, but where it's very challenging is that when you put together the SVB case and the 81, I think the question which comes in mind is, what is there left to bail in? Because SVB, the uninsured deposits were guaranteed. And you remember there was a big debate on the deposit preference. So the uninsured deposits were guaranteed, so no bail-in for that. And of course, no bail-in for any liability, which is pari passu to the uninsured deposit, meaning all the senior unsecured debt of the bank. So SVB case, the message is you are not going to bail in everything which is either the senior unsecured debt or the uninsured deposit. Credit Suisse case, the Swiss authorities did a massive bail-in of the 81, and there are really question marks as to whether the 81 market is going to revive after that. So at the very least, it's going to be very challenging to issue AT1 for a significant period of time. At the worst case, it's going to be impossible. So there again, this instrument in terms of bail-in, question mark. So I think, the bit provocative issue, but up for debate, is what is left to bail in.
Okay, no, that's right.
Senior unpreferred.
Yeah, but senior unpreferred. You're right. Tier 2
but then, of course, you have to question of the effect on the market, right? I mean, also, you just said yourself, I mean, it will be very hard to issue AT1 bonds. I mean, where do you see this market going in general? I mean, will it be just, I mean, I think the prices have come down, yields going up, obviously, but I mean, is it like a temporary thing, or will you see more in general, a structural difficulty of banks to raise AT1 bonds?
Yeah, you're right. I think, I mean, the double challenge here is that AT1 were bail-in, whereas equity was not bail-in. So you have an obvious, I would say, pecking order and hierarchy, liability hierarchy, which is rates. I think everybody underlined that. And I think the second challenge is that those AT1s were bail-in, whereas the solvency ratio was, much above the threshold for bail-in of those ratios. And third element, which I think is maybe, I mean, at least as important as the two previous one, is that it's a pure cancellation. So, you had an AT1, you get zero. Whereas in all the bail-in regimes, of course, you prefer first to convert into equity, because certainly your equity day one is going to be worth something very little, but you may have an upside if the bank recovers. Similarly, when you do bail-in without conversion into equity, the resolution regimes, in particular the BRRD in Europe, says that you should be given some kind of clawback, so that if the situation improves, you get some money back. And here, when you are a Credit Suisse holder of AT1, you get zero, with no upside whatsoever if the bank recovers. So I think those three elements, no creditor hierarchy implemented, a bail-in which occurred much above the triggers. Third, no recovery. I think those three elements are going to make the pricing of AT1s, because they're, given the uncertainty that you will face when you're an AT1 holder, it's going to make the pricing of AT1 very challenging.
I mean, Stefan, so Corso just made the point that, I mean, there was no resolution, but the certain tools of the resolution toolkit were be used, but it wasn't really like we expected it, right? I mean, there was kind of not how it probably we would have played it out in some kind of scenario planning and in crisis management exercises and so on. I mean, is it just that's the way it is when we're in a crisis? We always have to improvise, or have things improved since the reforms after 2008?
Well, this calls to mind the famous quote from the boxer Mike Tyson, right? Which is, everyone has a plan until they're punched in the face. Exactly. And this is kind of exactly what happens in crisis situations. We've devised elaborate plans, which we're all very proud of, and of course the crisis comes along, and we can't follow the playbook. So, but I don't think that we should quit trying. I think it's very important to, these things evolve over time, and the issue, for instance, I think it was very nicely put, these two issues. One, what do you do about uninsured depositors, and what do you do about these debt with capital characteristics? And I think we're going to have to find solutions for both of those, so that next time we eliminate one more area of uncertainty. I don't know on the effect in the US, people are already talking about having a debt requirement for these mid-sized banks. But I imagine some of this will have to go through courts, through a legal process to determine what rights are, similar to what happens in emerging markets kind of debt crises. Some will have to think of policies for the next time. But if we don't want to have a completely nationalized banking system, we still have to figure out what is the backstop that governments provide, and how do you size that backstop, and what's the role, unless we want to go to a completely nationalized system, which I don't think any of us want to do.
Well, but they also kind of, I mean, this is a very, you kind of say, what is the backstop? That's a very different question than the one we asked, at least in Europe 8 years ago, but also in the US, is like, how can we avoid future taxpayer bailouts, right? And of course, one of the issues with bailouts is this too big to fail. Now, are we giving up on that? I mean, Credit Suisse was, I mean, effectively was bailed out except for 81 bondholders through this private market solution. I mean, it's too big to fail, alive and kicking. Will we ever get rid of it, Elena?
Well, first, let me say, I mean, Credit Suisse was bailout, but was certainly not bailout to the same extent that we saw in 28. It's a completely different type of bailout. That we have to say. I mean, they didn't enter into the capital. So that's completely different, I think. And saying that for liquidity, it's uncollateralized, I'm fully with the course. So that's sort of bailout, but again, it's not the same as long as liquidity is paid back. So it is a difference from a commitment type of versus a spot loan. Right? There are two different things. So in a sense, despite all the chaos they created, I think they didn't go all the way down to 2008. Now, having said that, what would happen if UBS one day will have an issue? Who knows? Because here we are going even bigger to some extent.
Yeah, no, exactly.
But I think the idea that we can really create a too big to fail is a bit of an illusion. I mean, that we can avoid, the too big to fail.
Okay.
As long as, I mean, I think we have to be very careful. We need to distinguish whether a bank like Credit Suisse is an idiosyncratic case, and then we can find solution. They may be cleaner, they can be dirtier, but there can be solution. Differently from a Credit Suisse embedded into a systemic event. That's completely different type. And there, I think bailouts are inevitable. But bailout of the 2008 type, not this type.
Okay, no, that's clear. Yes, no, I think that's clear. Go ahead, Stefan.
No, I think Elena raises an important point that, I think this is different from 2008. Taxpayers are not don't end up owning these banks in either case, which is a good thing. I do think, and then what's interesting is, I mean, SVB was not that big a bank, so I don't know, how do you decide what too big to fail? What does that mean exactly? So I think we may need to kind of think about some general parameters. In the case of Switzerland or any, frankly, country, there is some limit to the size of a bank relative to the GDP of a country. I think we found that out in 2008 in the UK to some extent also. On the other hand, we don't want, and in the US, we saw this huge amount of deposits flowing towards the large banks as a result of the SVB crisis, which is creating a bit of a conundrum for the Americans because we're making the bigger banks bigger still through what happened at SVB. So how do we, on the other hand, SVB was too concentrated. So I think this whole issue of how big is too big is something that's going to continue to be debated over the continually.
Okay, thanks. Elena, sorry, you want to? Sorry,
I think Corso that wanted to say
a couple
something.
Of minutes left. Let me.
Okay.
Oh, Corso, sorry. Corso, go ahead.
No, so sorry. Very quickly, I think I just want to say that I concur with my two colleagues on two different points. I think systemic. SVB shows that smaller banks can also be systemic, and we said too big to fail, but we also said too many to fail.
Too many.
So I hope this. I hope this kills the idea of proportionality in implementation of the standards, which is a debate we have currently in Europe. But clearly, it's not the sole factor here, but it's a factor that needs to be taken into place. Second point on bail-in, bail-out, I think Elena put it totally right. I mean, the Credit Suisse recovery, or whatever you want to call it, was much less expensive than it could have been, or that it would have been in a 2008 context. Yeah. You're right. I mean, cash out is different from guarantees, and central reserves getting paid back. I think to be slightly provocative, I think SVB was bailed out the 2008 way. Really, I mean, I think the way the US authorities dealt with SVB is exactly the same way they would have dealt with the crisis back in 1990s or in the 2008. And I think Credit Suisse was a kind of hybrid regime whereby you have to say, it's challenging. We're going to see all the consequences, and it's difficult to be very definitive on that. But you cannot say that, the cost to public finance was a key element in decision making, and some money was saved.
But if I understand correctly,
I guess I would just disagree slightly on the SVB. issue in the sense that, I mean, equity holders were wiped. In a sense, the SVB was more classic. Equity holders got wiped out. You know, the FDIC incurred costs, but they'll be, what'll happen is they will charge all the banks to recover those costs. So in a sense, I think it's a little more classic personally, but anyway.
Let me maybe, we have a couple of minutes left. I want to bring up two more questions. One is, are there consequences for regulatory reform? Do we need more? Do we need Basel IV, Basel V, whatever you want to call it? Question number one. Question number two is, what is your view, to which extent be reflected also in the monetary policy going forward? Let me maybe start with Elena, then Stefan, then Koso.
So I think on the regulation, I think this is clearly not a crisis of capital, as we said from the start of this seminar. So if the classic regulatory response is further increasing capital, I think it is not the way to go. I think we need to think much more about two issues, liquidity, but also supervision. So, you know, we cannot have probably banks that have dragged on for years before they are back to be, they will always be stronger and weaker, but they have to be strong enough not to be subject to attacks or to anything like that. And on monetary policy, I think a lot will depend on what's going on in inflation. But if you ask me, should the monetary policy incorporate financial stability? I mean, we know that it has a secondary objective of financial stability. So in some way, it will be incorporated in the monetary decision, but that doesn't mean necessarily rates. It could be liquidity provision, liquidity tools, it can be other things.
Which of course might affect also the monetary policy stance, right? If you turn from QT into QE. So that's
exactly. There is the QE.
It could be shorter term rather than longer term.
Exactly.
You can replace longer term with shorter term.
Exactly.
Thanks, Stefan.
Without trying to repeat, I would just make one quick point that the trend in regulation has been for central banks to take an increasing role in supervision, meaning that generally since 2008 have combined these in the same institution. So it would seem to me that we need to have better communication within those institutions as to monetary policy on one side and the impact on supervision on the other side, because these two are inextricably linked. When we have higher interest rates, we're going to create stress in the banking systems. That should be telegraphing actions that need to be taken on the supervisory side.
And what do you think about, the monetary policy side, Stefan?
I think, again, the monetary, central banks have their mandate to do what they have to do. And I think the important thing is linking this with the supervisory side. You've got clear signals on what monetary policy is going to be, and it should be pretty clear what needs to be done elsewhere.
So no, I have no additional point on that one. I think, as was very clearly said, I think the conundrum here is going to be how to combine the tightening in monetary policy, or the tightening that may be necessary still in monetary policy, and the provision of liquidity to banks. And by the way, what's going to happen to the TLTRO in Europe, it's going to be an interesting thing to watch this summer.
Okay, great. Thank you. So I think we see some agreement there, at least, when it comes to what has to be done next and what we can expect next. I'd like to thank you very much. I'd like to thank also all our participants, and I'm sorry we couldn't address all of the questions and all of the comments and suggestions. But I'm very grateful to Koso, Stefan, Elena for their discussion. And let's hope for the best. I'm not going to ask the question, what's next? I think we just all see what's happened next. And I hope in terms of the audience, I hope to see you at some other online event of the Florence School of Banking and Finance. Thank you again. Goodbye.
Thank you. Goodbye.
Thank you. Thank you very much. Thank you, Thorsten. Thank you, Elena. Thank you.
Thanks.